take a look at what is happening right now in the newspaper industry. A lot of talk about whether or not the media landscape as it changes will continue to involve print. Well, today, Reader's Digest filed for bankruptcy protection, making it official. And just last week, Philadelphia Newspapers LLC filed a bankruptcy reorganization plan for its Philadelphia daily papers. Can print be saved? We're putting that question to someone very deeply involved in answering that question for his own business. CEO of Philadelphia Media Holdings, Brian Tierney, joins us now live. Sir, we heard last week that Philadelphia Media Holdings filed reorganization plan. You're very much in the trenches here trying to get the Philly papers to survive. What's your plan to do that?
Well, we've announced our plan. It's a $92 million plan. It involves about a $52 million new commitment from local equity, $35 million in cash equity, and the local investor group is willing to put up a $17 million letter of credit for workers' comp. The banks get $66.6 million in cash and real estate. We wind up being debt-free, which I think is key. I mean, one of the challenges of all media, TV, radio, certainly newspapers, is this advertising economy is a tough one right now. Most people are saying, I saw Barclays said 10% decline next year in newspaper advertising, so you don't want to go into next year with a millstone of too much debt around your neck, which is how some of these restructuring plans seem to be working out.
Now, this reorganization plan that you filed is still subject to approval. What has been the reaction so far from your lenders? And secured creditors get about 21 cents on the dollar.
Yes, they also avoid about a $25 million of exit costs that they would have to that have to be paid before we get out of bankruptcy. So that's for the total. Some of them have said, we have this in a CLO, and therefore we're a partnership, and Brian, cash doesn't do us any good because it goes right out the door to our investors. Okay, you think that would be good for your investors, but anyway, others that are more traditional banks, some of whom have purchased it at 13 cents, are very interested. They're asking us how many spaces in the parking garage, how large is the building, et cetera, what part would we occupy, et cetera. So I think so far, touch wood, so good. There has been, although some are saying that they don't want it, others are being very aggressive with us in terms of asking for more details. So I'm quite hopeful.
Now, this group that has come forward and submitted this reorganization plan, these investors that you've gotten to work with you on this, who do they include? It has been reported that Bruce Toll of Toll Brothers is one of the investors.
Yeah, Bruce Toll, who was an investor in the first go-round, is our lead in terms of this process. The Carpenter Union Pension Fund has also invested, and a local investment company called Penn Matrix, which is locally based with very wealthy, very philanthropic Philadelphian behind that as well, have stepped forward. These businesses aren't going to be great economic engines anytime soon. So I can understand the banks in our group who think, gee, if you can give me 22 cents plus another 11 cents of costs I avoid, that sounds pretty good. I don't want to own a Philadelphia newspaper. But if you're locally based and you're not really interested in short-term rewards, but you do it for other reasons because you know it's important for your community, I think these papers can be very viable. I think the printed product will be viable for a certain time as well, for at least an extra 10 or 20 years. And I look at things like Politico.com, which is a website, but they're making all their revenue off of their printed, 3-day-a-week printed product. So if they didn't have that, they would be in the tank. So the printed product, advertisers love the printed product. Mm-hmm. We have $200 and some million worth of advertising this year in the printed product, and we won't be walking away from it anytime soon.
Are you putting your own money to work this time around? I know back in 2006 when you helped purchase it, you were involved. Are you involved financially in this round?
Yeah. The first time I was a $10 million personal investor. This time, because I have this fiduciary role of wanting to present the best plan for the court, and one of the things that we've offered for the court as well as to prove this is the best plan, we're suggesting an auction process to see if other bidders step forward. I've decided that this plan doesn't have me investing, and nor does this plan have an employment contract for me, because I wanted to make sure that everybody would feel like I was being an honest broker to look at other bids that may come in as well. At some future time, I may decide to do that, but I haven't made that decision.
Okay. With the advertising climate as soft as advertising market as soft as it seemingly is right now, how do you plan to make the print media here profitable?
Well, what we need to do is to continue. You know, we've carved $95 million out of our cost structure, out of a $400 and some million paper when we first picked it up. About 40 of that has come out of wages. Half of that comes out of management, which I'm proud to say, and we've carved about another $50 million. So there are more efficiencies to be found, for sure. They're harder and harder to find. But what we need to do is to find those efficiencies, have a reasonable expectation about return, which our investor group does have during this time, and get rid of the millstone of debt. The banks are proposing a plan that, frankly, I think puts more debt on the company than it's worth.
Okay. Thank you so much, Brian Tierney, CEO of Philadelphia Media Holdings. Thanks so much for joining us live from Philadelphia.